Good afternoon, everyone. This is Art Aiello, Managing Editor of Farm Equipment Magazine. Welcome to our latest webinar, Secure Act 2.0, What You Need to Know, in conjunction with tax-favored benefits. Today's presenters are David B. Wentz, CEO of Tax-Favored Benefits, and Brandon Badke, Vice President of Retirement Plans for Tax-Favored Benefits. Over his 25-plus year career, David has worked to build a national footprint. He has been the recipient of a multitude of awards recognizing his hard work and achievement in the industry. In addition, David has led multiple insurance companies in retirement plan and life insurance sales. He also speaks at various professional and business seminars on the subjects of pension, profit sharing, 401k, tax-favored benefits, and investment programs. Brandon heads up the administration department for tax-favored benefits, which consists of all compliance testing, 5,500 filings, plan design, and profit-sharing calculation. He was formerly employed as a senior account associate at a national accounting firm. Brandon has more than 8 years of experience in the financial services field and is Series 7 and 66 licensed. Before they get started with the presentation, I have a couple of housekeeping items. On your screen, there is a control panel with a Q&A icon. You can submit questions here at any time during the presentation. Time permitting, we will work to answer as many questions as possible following the presentation. This webinar is being recorded and will be shared with everyone who registered in the event you want to rewatch it later. Okay, we're ready to get started. Thanks again for joining us. Take it away, David.
Good morning, good afternoon, depending on where you are. So Art, thank you very much. We really appreciate this opportunity to talk a little bit today about Secure 2.0. And I think we're pretty excited about it. We want people to have great retirement plans, and there's been a lot of good work done. If that sounds a little ironic with the government, with this piece of legislation. So as we go through, as Art said, please reach out with any Q&A, and if you want to contact us afterwards, please feel free and do that also. Brandon and I have a lot of experience in the ag industry, and so we understand who your people are and who your constituents are, and I think there's some positive with this for your plans. I think it's also always relevant and important when we're talking about the 401k to realize that the best benefit you all give is a job. And I know in the current environment with low unemployment and some of the things we've been going through as employers the last couple of years, we forget that. But the best benefit you all give is a job, and then comes your health care if you offer it, and then comes the 401k. And so 401ks are defined contribution plans that allow people to defer money in, and oftentimes there's a match or profit sharing feature. So 401ks have really evolved, especially in the last 10, 15 years, and the Secure 2.0 is a natural evolution of that. Other thing, the government put this out, and there were some immediate things that people are required to do, and there's been a little bit of panic about that. So I think it's important for us all not to panic, take a deep breath, realize whenever the government does some legislation, there's some unintended consequences. We'll talk about that. And really the intent today is to take away some ideas so you can go talk to your broker or your TPA or your HR department to improve the plan a little bit. So Brandon's going to pull up the first slide here. And a little bit about Secure 2.0. In the bifurcated political world we live in, there's not a lot of legislation that's done jointly by the two major parties. But this is a really nice piece of legislation. If you have an existing plan, some of it's mandated. Most of it you can opt in or out of. If you don't have a plan, there's some things that are going to be mandated. But this was passed at the end of 22. And it's a big piece of legislation. There are 92 provisions. So most of it applies to retirement plans. A lot of that applies to 401ks and profit sharing. There is a fair amount that applies to not-for-profits and government plans. It doesn't apply to us, but it's a big piece of legislation. And some of it you're going to like, and some of it you're probably not going to want to like or don't need to like. But we're going to talk about the big picture today. We could probably talk about some things that don't apply, but we're going to really focus big picture on the things that we think are the important elements and kind of go from there. So one of the things that we've done with this piece of legislation, there were things that immediately became applicable that are automatically in your plan that need to be added. And there are things on a timeline that are going to evolve. So we're going to kind of go through this timeline and talk a little bit about what was immediately part of your plan that needs to be incorporated into your document. And the first piece is a very positive thing. With the climate being the way it is, whether it's change in climate or just weather being weather, there's definitely natural disaster, whether it's a hurricane, a tornado, flooding. There were some really nice provisions put in that allow people to get access to their 401k money and profit sharing money exempt from the 10% penalty. And it kind of expands the repayment if there's a loan, and it expands the loan provision up to $100,000 for this. So Brandon, I'm gonna have you take off your audio there and maybe talk a little bit about that if there's anything as we go through this. Was there anything that you wanted to add to that piece there?
No, you covered that, Dave. Yeah, the natural disaster, that's kind of been in there for a little bit. It was part of Secure 1.0, where they allowed that. And it's a federal declared disaster of some sort. And they've expanded the time frame as well to, I think it was 180 days after said disaster or declaration that you can take your funds out if needed.
All right, so then moving on to the second or the big picture item that was immediately added at the end of 22 was the 3-year limit on repayment of qualified birth or adoption distribution. So another really positive thing for families. Adoption is a really expensive process. So this kind of expanded the features for that. So it happens maybe a little more than we think, but it's a nice provision, a nice add for families. The next piece was the expansion and recoupment limitations, the EPCRS. And really what this means for you and for your broker and for your TPA is that if there is an issue or a mistake made in the plan, that the Department of Labor and the IRS are going to be a little bit easier to work with for corrections of the plan. Maybe Brandon add a little texture to that.
Yeah, so just as Dave mentioned, it is kind of a reprieve from kind of allowing any corrections that are needed, kind of expanding the timelines. A lot of the provisions in the corrections previously with the DOL, you'd have a certain time frame to get that done. They've expanded depending on what the correction is, they've expanded the time frame to allow people to catch these corrections if there are any, and get them corrected in the time that they see fit. So that's kind of a big thing, more from the administration side of things. And so there's no pressure to hurry up and get things corrected to avoid any penalties or fees. They did expand that pretty far out. For me, from the admin side, it helps us a lot because we are saving our clients some money for penalties if there are corrections that need to come up.
Yeah, I think it takes a little bit of the fear out of the process if there's a mistake made, or if you're looking to move your plan to a new provider. Gives you a little bit easier process to get that cleaned up. One of the really big things that we might spend a little bit of time on was obviously in 401ks, there are 2 ways you can defer money as a participant: before tax traditional, where the money comes out before tax, gross tax deferred, and you're taxed at retirement, or the Roth 401k feature, where the participant historically has been able to defer money after tax. And up to this point, employer contributions for matching traditional or safe harbor or profit sharing have been before tax dollars. And so the optional Roth treatment of employer contributions was added. Now with that sounds exciting, but this legislation really caught the industry a little bit off guard. And so a lot of the payroll companies and product providers aren't ready to do this. And then there's been some question about how forfeitures would work and loans would work. And so while conceptually it's a really nice thing, and if you have an existing plan, that doesn't automatically happen. You'd have to adopt that. For newer plans going forward down the road, there's some that's going to be going to be a more prevalent feature. But Brandon, maybe talk a little bit about the unintended consequences with that.
Yeah, when the big thing with that is one like Dave said, we're all record keepers payroll. We're waiting on guidance from the IRS on this. They rolled it out, but it's not implemented yet, just because they're trying to determine how that's going to be taxable to the participant up front, whether it's going to be taken out of the FICA, whether it's going to be considered like almost like a distribution and a new code on a 1099 form, or it's just going to be taxable income. So we have not heard that. I know a lot of the record keepers we work with, they have representatives that are assigned to Capitol Hill that are kind of discussing with the best way to adopt this in. So I know we have some clients that are looking forward to possibly implementing this. So we're waiting to hear back on that. A couple of things to look on that one. They did say that it came out. So if you have the Roth treatment if you classify it as a match, it would have to be 100% vested. So you couldn't have, if you're not 100% vested in your match, you could not do Roth. So you'd have to be 100% vested. That's one of the big things. And so I just think people, I just have to be educated whether it's in their best interest to classify that as Roth, whether it's an administrative headache for the plan itself. So I think those are the things that need to be considered while adopting that into the plan. And as Dave said, that is an optional provision. So plans do not have to adopt that into their plans.
Right. And one of the other immediate features was the pension mortality change, which we're really not going to talk to. So if you do have a pension plan, you have some questions about that, please feel free and reach out to us offline. So some things coming up into 2023, really one of the most positive things was the required minimum distribution, or the amount of money somebody has to take out, has been increased to 73. And at the start of COVID, it had been 70.5 and got bumped to 72. And that's going to continue to increase up to age 75 in the year 2033. So I think that's a really positive thing. It's not saying you can't take your money. It just allows you to move back the time frame when you have to start taking your money. And I think whenever you have increased flexibility, it's a really positive thing for a wide selection of participants. I think the new startup plan tax credits, and this obviously is for people who are setting up new plans, the government really wants people to have plans. In fact, there's a bill in front of the House right now, the House of Representatives, that would create a federal program for participants, for companies that don't have plans. And I don't like mandates, but the new tax credit really is something that we'll talk about a little more detail at the end, but it gives basically $15,000 to be spread across 3 years, or $5,000 a year for startup costs. So that's a positive thing. The other thing, limited disclosures on unenrolled participants. So as people elect to get in or get out of your plan, once they are unenrolled, you have a reduced responsibility to give them new disclosures. So not that they can't get in, nothing's being taken away, but it takes away a little bit of the information burden from the TPA, the employer, the HR department, and then the platform provider. Brandon, you have anything you wanted to mention about that?
Yeah, the only other thing is participants currently, the prior state was any participant or employee, I should say, that was eligible for your plan, even if they did not contribute or did not enroll in your plan, as long as they were eligible, they were required to get most of those disclosures and notices. And that's kind of what this is eliminating, is they're no longer required to get those along with anybody that's left. It's just those that are going to have balances in your plan.
So that's a positive. Other thing, de minimis financial incentives permitted. I'm not sure how I feel about this, but I think anything to help people get in. You now basically can give a gift card to somebody who enrolls in the plan. That seems pretty minor, but that's now a viable thing to do for your participants. Cash balance accrual rule testing modifications. Cash balance are types of pension plans or defined benefit plans, which most ag dealers don't have. But if you do and you have questions, feel free and talk to us about that. So um, obviously this piece of legislation, there are things that come in every couple of years you can opt into or are mandated to do. But in 24, which will be here quickly, the catch-up contributions are required to be Roth contributions. So that would be, obviously, there's the legal limit on what you can put into, and if you're over 50 and now another number over 60, the catch-up provisions are going to be required to be Roth contributions. And I guess, Brandon, maybe a point of delineation, is that does that have to happen for existing plans, or is that just for new plans, or a little bit of both?
So that's going to be for all plans. And that catch-up contributions, the Roth, that's kind of the big ticket item, I would say, in 2024. Kind of one of the bigger items talked about in the Social Secure Act is how that's treated. So the catch-up contributions right now for 23, anybody over the age of 50 could put in an additional 7,500. Now that, I mean, that does not change. Year to year, it may change due to inflation, but just for presentation purposes at 7,500, they're now allowing at age 60, 61, and 63 that you'll be able, those ages, you can contribute more and catch up. They set the standard at 10,000, but that'll be adjusted each year. And that comes in actually 2025. You'll see later down on this timeline, but it's all kind of tied together. But one of the big things is the catch-up contributions will be required to be Roth contributions for anybody making over 145,000 in the previous plan year. So there's a couple ways to think about that. If somebody's normally they're doing catch-up, they're doing it pre-tax, they'll be required to be in Roth if they're making over that dollar amount. And also, if your plan does not currently allow for Roth contributions, one of two things will need to happen. One, you'll have to amend your plan to add the Roth provision, or two, catch-up contributions will not be able to be made by those making over 145,000.
All right, good clarification. Another kind of important thing in my mind, obviously, is the cash out limit increase to 7,000 from the current $5,000 number. So in your plan, as people leave, I have a personal bias that if they leave your organization, you want to get the money out of the plan. And if somebody has between 0 and 1,000 now, you let them know that where do they want the money to go, and if they don't respond, you can send them the money minus the taxes and any penalty. If somebody has right now between 1,000 and 5,000, you can force them out and roll it into an IRA to keep the plan clean, and that $5,000 number has been increased to 7,000. So going forward, anybody that's 100% vested over 7,000 can stay in the plan, but they've expanded that a little bit to help keep the plans a little bit cleaner. Brandon, anything on that?
Yeah, I agree with you, Dave. I think that's a great rule, increases, because most, not all, but I would say most 401k plans in the record keeper, you get a charge by a participant with a balance. So if you have somebody that's been a terminated employee for 3 years and they're sitting there with a balance under 7,000, you're basically paying for that person to be in the plan. So now we can get those people out, and so that's it. That's a big positive in my book as well.
Right. And I'm genetically inclined to be a little bit wordy, so there are a couple of things that aren't as prevalent in this that I'm going to go by. But one of the other things I think is really important, unfortunately, domestic abuse happens, and so they've allowed in-service distribution starting in 24 for domestic abuse victims. So somebody will be able, if they're in a situation like that, to pull money out with avoiding the 10% penalty. So people who have money in their 401k and they need to get started or need to break away are going to have access to their 401k a little more cost effectively to do that. Along the same lines, personal emergency in-service distributions are permitted. That's a positive. That makes the hardship provision a little bit more palatable for somebody penalty-wise. Brandon, anything on either one of those?
Yeah, some of those tie together in a lot of these new distribution reasons that they have. They're allowed to be paid back, and that's a good thing. So if somebody needs the money now, they can pay that back. Whereas, say you take a hardship distribution that is not paid back, and you have the early withdrawal penalty on that. And a couple of these things, like the personal emergency, they do have limits set on the amounts you can take. I believe the personal emergency was a little lower in that you could only take up to 1,000. And you can only take that once a year. And once you have that paid back or have contributions into the plan that cover that same dollar amount, you can take another one out. And another thing with these two right here is they are self-certified, which means that you don't have to provide any proof. The participant self-certifies a form saying, I need this for this reason. And so the liability is off the employer for signing off. That kind of applies to how the hardships currently work. And as we'll talk about a little later, hardships can also now be self-certified as well. That will be an optional provision, but it's all about taking some liability off the employer, because typically with the hardship, you'd have to see proof of the documentation and approve that. And if we see some employers that they just sign off on things, and if they're audited, it comes back, if they don't have documentation, they're essentially liable for that. So all good things around those.
Right. The other thing too that's important in 24 is required minimum distributions from designated Roth accounts are exempt. So that's a positive thing for financial planning, with people wanting to figure out how they take their money out of the plan, that the RMD with Roths are exempt. Another important point, obviously, student loans and debt, it's a tough thing. So student loan matching programs, people are going to be able to, if they want to, adopt into their plan that the employer contribution can be used for loan repayment if they want. Brandon, anything about that we're seeing?
Yeah, that's falls sort of in the same category as the Roth match. Waiting on some more guidance from the IRS. I think the Roth match and the student loan are probably the two bigger ones, issues with the Secure 2.0. And they're still waiting, like I said, for clarification on how exactly these will work. And I know with the student loan matching program, we have had some inquiries, and there's a lot that goes into them, and they are optional, so the plan does not have to allow. And I think it will require some work on the employer side and also with the TPA side for these, because essentially you're counting. If a participant has a student loan of $200 a month, you got to figure that into. That's essentially they categorize that as their deferral into the plan. So they're matching on that $200, the same formula if that was a $200 contribution out of their paycheck into the 401k. And so there's some calculations and some work around doing those, but in the end, it's a great thing. It's just we have to make sure everything is set up correctly on those. And that kind of is going to fall back a lot on the record keepers and the payroll providers to implement into their software, which I know it's being worked on because that is a big ticket item.
So a couple items here. As you add employee, people come in, they can't find their statement from their previous provider or previous employer, or it goes back more than that. The DOL has established a new retirement plan savings lost and found database. So that's a really positive thing. Family attribution rules and top heavy minimums. Without going into too much detail, obviously with the qualified plan, you need to basically make a 5,500, which is the tax return for the plan. And this is just allowing the rules to be expanded and modernized a little bit. And hopefully the entrepreneurs and the families of the owners or the key employees, highly compensated employees, allows them to put a little bit more money in it for it to be a little bit cleaner. If we go to 2025, automatic enrollment, something years ago when it came out, I was not a big proponent of, and I have become a proponent of it. And it basically allows you to auto enroll employees as they come in, and they can opt out of that. So Brandon, talk a little bit about the automatic enrollment requirement for not existing on the date of enactment, real quick.
Yeah, so the automatic enrollment is going to be for all new plans that start on basically since 1/1 of 2023. All new plans by 1/1 of 25, they will be required to have auto enrollment in the plan. That will be a requirement for all new plans started after 1/1 of 23. So anything started after 1/1 23 kind of got a little grace period until 1/1 25, and then it'll be required into the plan. So plans will have to be, your documents will have to be amended, and that's set up. And there's a
Gotcha.
couple, real quick, there's a couple exclusions from that. Companies that have been in existence less than 3 years, they have less than 10 employees. Those are two exclusions from that.
Perfect. But if you don't have auto enroll, this may be something worth looking at in the auto increase side of that also. Brandon, real quick, the required service for long-term employees. I know that's kind of a mundane thing, but that's something that can clean up plans a little bit.
Yeah. So what that is in the Secure 1.0, or maybe it's the CARES Act, one of those two. They implemented the long-term part-time employees rules, which started in 2021. So if you have a part-time employee that's worked 3 consecutive years of at least 500 hours per year between 21 and through this year, starting on 1/1 of 24, they are eligible for the 401k plan to defer into it only. You do not have to match them, or they are not eligible for profit sharing, but they are eligible to contribute their own funds in there. That was the 3-year look back, and the Secure 2.0, they brought that back to 2 years. So it's always going forward. An employee that works 2 straight years of at least 500 hours is eligible for the plan.
Great. I think that's really everything about 25. In 26, one of the tough things is most platform providers and vendors want to go to a paperless universe. And I can understand that for people who want that. In any plan, typically, we see this a lot with ag dealers too. There are people who want a paper statement. And so basically with Secure 2.0, there's a paper benefit statement requirement starting in 26. So me personally, I think that's a positive to make sure everybody understands what's in their plan. Because there are people who really don't want to use the technology, and quite candidly, with the increase in cyber crime and it really being increased in the 401k space, I understand that from a participant's view for sure. Brandon, anything about that?
No, you hit the head right there. And they will require, even if they're set up for electronic delivery, they still, at least annually, will be required to get a paper statement from the record keeper.
All right. And then in 2033, the RMD increases to 75. So that seems a ways off, but that I think anything that provides flexibility and planning for your participants and you is a positive thing. So maybe going on to the next slide, we'll go into, we've talked about these things in a little bit. And before I do that, the one thing I do want to mention, whoever you have as a platform provider or use as a TPA, third-party administrator for your retirement plan, your 401k, there is a ton of great information out there that goes into a lot more detail. We've really taken everything and tried to look at what we think is relevant for a big picture. But if you want to get into the details a lot, please feel free and email Brandon or I, and we'll send you, whether it's Vanguard, Fidelity, Hancock, Empower, they all have really good pieces on this. So Brandon, maybe talk a little bit about the provisions effective 1/1/23 with the RMD. We've touched on that, but maybe talk about a little bit about what's mandated.
Yeah, so for 2023, as they mentioned, we kind of skipped on some of this, and we kind of hit a little more detail on some of it. The RMD is the big one, went to age 73. There's nothing required of anybody, so there's nothing anybody needs to do. And one thing, I apologize if I mentioned earlier, if somebody has Roth money, they do not have to take RMDs from Roth anymore. And so if somebody has 100% of their balance in Roth, they're not required to take an RMD no matter what age they are. So that's a good thing.
And I think we talked about the next piece already a little bit. We talked about the Roth. If you have questions, please feel free and ask them to Art or us. the self-certification with the hardship withdrawal, maybe talk a little bit about that just in a little bit more detail than we did already.
Yeah, so currently, this is in place. A lot of the record keepers, this is also waiting for a little bit more guidance, not so much from the IRS, but from the record keepers, where we want something that a form, we're waiting on forms from these record keepers. So typically with the hardship withdrawal, there's 7 reasons that the Department of Labor came out with, or they can take money out of their 401k plan. I don't have them all in front of me, and I'll figure out the top of my head, but it's like for mortgage payment, or down payments, student education, funeral expenses, medical expenses, things along the big picture items. People are allowed to take a hardship up to only the amount needed to cover that amount. So they would have to they were required to show documentation, whether that's a medical bill. And just so people, if the medical bill is $500, you can't take out a hardship distribution for $2,000. It'd have to be $5,000 or $500, the exact amount of the documentation. And that was on the responsibility of the employer to approve that, to get the correct documentation and say, hey, this meets criteria. Us as a TPA, we provide guidance on that in our opinion, not being depending on if they were 316 or not, but we can't tell them definitively, hey, we agree with that. We just give our opinion. And so now this takes that liability off the employer, to where there's a form that the participant can sign that says, hey, I'm self-certifying, I'm taking out the amount needed for this reason. And so if an audit comes up, that documentation is sufficient to take the liability off the employer. So I think that's a big rule for not only from the admin side, from also the employer side, to where that liability is lifted off you. This is a optional provision in the plan document, so you do not have to allow this if you do not want. So if you still want to continue to have the participants provide that documentation and you sign off that it does meet the criteria, you definitely can. But if you want to allow for self-certification, you definitely can as well.
And obviously we talked about this a little bit, so we won't go into a ton of detail. And obviously, if you'd like the slides, or we can get them to you. But the new in-service distributions added the date 1/1/23 for disaster recovery. Expanded the loans a little bit up to 100,000 or 100% of their vested account balance, which, we've seen a fair amount in the Midwest with flooding, whether you're by a river or rain, or obviously plans in Florida and California. We've seen this, so this is a pretty big deal. Effective 1/1/23 for terminally ill patients, that's been expanded. So that's a positive. Emergency personal expenses. So we've talked about these, but wanted to reiterate, because like I said, anything that makes the plan a little bit more flexible is a really positive thing. We talked about the auto enroll in a little bit more detail already, but like I said, if you've looked at this and didn't like it in the past, most vendors, whether it's Fidelity, Vanguard, Empower, Emeritus, whoever it is, have gotten really good with this. And typically, if you talk to your broker, you're going to find that most participants really don't mind doing this. And this has really transitioned a little bit from something being driven to increase participation to get around top-heavy testing, to something that's more about financial health for your participants. Because typically, I think you're going to have a 401k to recruit, retire, reward, reverse tax discrimination. And it's about financial wellness, so your participants can retire when they want to and when you need them to. So something definitely you should definitely be looking at a little bit. We talked about Brandon, we didn't talk about this really too much. Talk a little bit about the 500-hour in the 3 consecutive year.
Yeah, this kind of breaks it out a little more to where, like I said, in Secure 1.0, they first came up with this rule of a long-term part-time employee eligibility, where if somebody's starting in years 21, and it ends at in beginning in 1/1 of 24. There's a look back to where you have to determine if you have any part-time employees that have worked there 3 consecutive years and worked at least 500 hours, you have to make them eligible for the 401k plan for them to be able to contribute in. As I mentioned earlier, you are not required to match them. They are not required to get a profit sharing. They're only required to be able to put in their own money in there. With the Secure 2.0, they're just lowering or reducing the years to 2 years instead. So starting in 1/1/23, somebody's only going to be required to be there for 2 years, working at least 500 hours to be eligible come 1/1 of 25. So I know sometimes that can be a little confusing. However, I think the payroll providers should have this data all lined up. I know we work with our clients to determine who's going to be becoming eligible for the part-time people, if they have any at all. Some people might not even have part-time people have just worked less than 500 hours for 3 consecutive years. So it's something to consider towards the end of this year. Reach out to your provider, your current provider, and just make sure they're on top of this to let you know who's going to become eligible. I know we've worked with our plans and our advisors are ready to go on for those people.
Great. And then once again, we talked about this a little bit, but I think this is a really positive thing that allows people to put a little bit more money in. Obviously, there's the catch-up provision for folks that are 50 or older. And then for 60, 61, 62, and 63, starting in 1/1 of 25, that's going to bump up to a base index of 10 grand. So that's positive for sure. Brandon, as we scroll down, we've talked about the student loan. I want to leave a little time for questions. So we talked about the student loans already. That's kind of optional, but as you're looking to recruit people, and I know it's hard to get mechanics and certain people that a lot of people are competing for, that would be a nice feature maybe from an HR perspective to recruit to. Also want to talk a little bit about the tax credits. 100% tax credit for new plans up to $5,000 a year for 3 years. The other one that's nice is 100% tax credit for employer contributions into the plan for new plans that have 50 or fewer employees. So it kind of goes through that, and it's a 5-year phase out. And I wish this was for everybody with their contributions, but it's for the newer plan. So that's really a positive inducement. So with that, a couple of things I wanted to mention. One of the things we're seeing with those of you that have larger plans that have a CPA audit, make sure you have those investment policies. We're seeing those being asked for and notes from your investment committee meetings. So with that, we did a lot of talking, and my mother used to say, be good, be quick, be gone. So we've pretty much talked for about 40 minutes. Wanted to open it up to any questions, Art, if you gotten any.
We did, yes. So the first question is this. Many small dealerships have simple IRAs and not 401ks. There were changes made to those for 2023, but there has been little information out there on that. Please speak to those changes, especially the one allowing Roth simple IRA contributions, and when will we see guidance on how to implement that for our employees?
Brandon, do you want to handle that?
Yeah, for simple IRAs, I don't have a whole lot of information because as a 401k administrator, I did see a piece, and I apologize for not having an answer right off the top of my head on this. I did see a piece from John Hancock recently that kind of went through some simple IRA stuff. If you provide your information to Art, I can definitely get that information over to you to answer those questions. And Dave, I mean, we don't see a whole lot of simple IRAs in my world now.
Right. I'm looking to that, and Art, I apologize about that, but we will be able to get, if you can get who that's from, we will get an answer for them post haste.
Oh, I just seen something. Might have real quick
Art-
here. Yeah, I apologize.
All right,
I'm sorry, my
my
apologies. That one of those, meant to unmute things. We do have another question. Will a plan be required to add the Roth provision to the plan in order for catch-up contributions?
Simple answer is yes, they will be required to amend their plan document if they want to allow for those, yes. The Roth provision has to be in the plan. I know there's some talk about the guidance hasn't come out about whether you can kind of specify whether you want to amend the plan just to allow for the catch up on Roth and not the other regular contributions. But we have not received guidance. The general thought in the industry is that you'll have to have the Roth in for all contributions in the plan.
Okay, another question. Is hardship self-certification an optional plan provision?
Again, that's a yes. I kind of mentioned it a little earlier. You do have that choice to whether you want to take that liability off yourself. Well, I know we also have plans that they want to be on top of everything, make sure that everything's on the up and up, and people are showing documentation for those hardships. So, but it is an optional provision where you can add that to take the liability and let them self-certify, or you can leave it as is and make them provide documentation of their request.
Okay. Are the Roth match contributions and student loan match provisions required or optional for plans?
Those both will be optional.
Okay, and last question right now is, would the long-term part-time employees be subject to the new mandatory auto enrollment?
Okay, so the first answer is yes, they would be. They're still waiting on a little guidance on when that's going to be applied. Because as I mentioned, with the new startup plans, they have to 1/1/25. They're going to have to be auto enrolled. So it's kind of, they're determining whether they have to do it right now, starting 1/1/24 when they become eligible for those that do have auto enroll, or if they're waiting to 1/1/25. The consensus is it's going to be yes, right away. They are going to be eligible for that auto enroll.
Okay. One last thing I wanted to ask, and David, I believe you brought this up earlier. Are you willing to share your slides with those who?
Of course.
Okay. Excellent.
Of course. And the other thing too is we do have a lot of other material that we've put together and our platform providers have, and we're certainly glad to share that too. That goes into a lot of detail. So absolutely.
Okay, let me just give another few seconds, see if there are any other questions that come in. We'll see if we can answer those. So just wait another second if someone's typing something.
One last item I kind of want to bring up that Dave kind of triggered me when Dave mentioned about these plans audits or large plan audits. One of the new rules that's just passed, it wasn't part of the Secure 2.0 or anything, but it's a change in how audits are calculated on who is required to have an audit. Because currently it was 120 participants, eligible participants at the beginning of the plan year. And so you could have 5 people with balances, but if you have 130 that are eligible, you're required to have a large plan audit. They've recently changed that beginning 1/1/23. So when you're doing your audit next year for the 2023 plan year, you may not have to do an audit because they're going off balances. So it's going to be a flat 100 balance is going to be the cutoff. So if you do not have 100 balances in your plan at the beginning of the year, you will not be required to have a large plan audit.
I think the caveat with that is too, is if you have people that are under that $7,000 limit, get them out now while you can and save yourself the price of the audit, because those audits can really range from $8,000 to $25,000 a year, depending on who's doing the audit and how big the plan is.
There we go. I am not seeing any additional questions. So With that, we're going to wrap up. That is all we have time for, and today's presentation and audio will be made available on the Farm Equipment website in the event you'd like to go back and review it. Watch your email and the Farm Equipment newsletter for more information. On behalf of David, the Tax Favored Benefits team, and the Farm Equipment staff, thank you for joining us for today's webinar. Please feel free to reach out to me if there are any topics you'd like to see us cover in future webinars. Thanks again, everyone. Enjoy the rest of your day.